French and I have known each other for many years, and I describe you as the triple threat. You were a banker, a very successful banker. You worked in the executive branch, so you know how the building, especially Treasury, runs, as well as the White House. And then you've been on Capitol Hill in a number of different iterations as a staffer, now as chairman of an incredibly important committee. I think as I look at your committee and your leadership, it really is the adults in the room, and I want to applaud you for all the work that you've done. So as becoming chair, what is your philosophical approach to the job, to the industry? How do you step back and how do you approach this position, given all your years of experience? Lay out your vision for what you want to do in this, and how do you think through it?
Right. Well, first, let me thank Tim for your work here at IIF and our 30 years of friendship going back to those days in the administration of George H.W. Bush. We had a lot of good work together. My philosophy for the Financial Services Committee, we oversee the housing markets, which includes the GSEs, the government-sponsored enterprises, Fannie Mae and Freddie Mac, Federal Home Loan Bank System, and then obviously we set policy for the depository institutions in the country through our Financial Institutions Subcommittee, and then the capital markets more generally, so the SEC and all things related to capital formation. And our philosophy about that is about being pro-economic growth. Since Sarbanes-Oxley in the early 2000s and Dodd-Frank in 2010, the American economy has just been more and more burdened with prescriptive, very detailed regulatory burden on all institutions of all sizes. And it's really never been adequately tailored, and as a result, you have responsibilities in depository institutions or broker-dealers or registered investment advisors that are, the same for J.P. Morgan as they are for a smaller bank. And so one principal philosophy there is tailoring that regulation. And when I was running for the chairmanship of the House Financial Services Committee, I published a 3-page single-space list of things I thought that would make community banking great again. But when I say that, it's not scaled only to small banks or small credit unions. It's up the entire ecosystem, because here in America we have the substantial proportion of the deposits in our biggest globally systemically important institutions, but we have 5,000 depository institutions that are bearing this burden, and as a result we have a lot of small banks and we have the great big GSIBs, and we want to make sure we've got a more distributed size and profitability throughout the institution, throughout the industry, and I think you do that by better tailoring regulations. So that's a key theme. So what can we do that's pro-growth in housing, pro-growth in capital formation? We consider our committee the Access to Capital Committee for the United States.
Obviously, you have, as you mentioned, 5,000 institutions. You have everything from J.P. Morgan to the Bank of Murray, where I grew up, my hometown, $200 million balance sheet. Do we have too many institutions? Should we have consolidation? And how do the smaller institutions compete with the larger institutions in terms of just tech spend? J.P. Morgan spends, $14-15 billion a year on technology.
Yeah. Well, I think in the 90s we've seen consolidation since the peak in 1980. So I think when I started my company in 1999, there were 275 or 280 banks in Arkansas. Today there's 75, and when I started my career, before many in this room were born in 1979, you probably had 30,000 financial institutions over the course of it, and that's down to the numbers we talked about today. That was driven by profitability. It was driven by personal philosophy. I don't want to be in this business anymore. I want to sell it to somebody else who can do a better job. But in the 90s, it was sort of driven by technology. And what's been exciting for me to see in the 90s and the 2000s is technology now facilitates even the smallest institution from offering competitive services, both at consumer and commercial customers. And so technology is not a reason to exit the financial services business today, whether you're a $750 million community bank in Little Rock, Arkansas, or a registered investment advisor working with small institutions. What's driving people out of the business today is the burden of regulation that is untailored and disproportionately borne by those smaller institutions. They don't have the scale now not to compete and offer their services, to their customers. They don't have the scale to meet the needs of the FDIC, the Fed, the OCC, the SEC, the FINRA, the MSRB, the BYOB, all these organizations. Checking to see if you're listening. And so you've seen Jamie Dimon's famous chart from the 2010 crisis that kind of rivals Hillary Clinton's healthcare reform 1994 chart. Well, it's no better. It's gotten worse on duplication. It's gotten worse on intrusion. It's gotten worse of ignoring the forest for some individual tree that somebody just invents as something that you want to go in and attack an institution by an enforcement action instead of by a thoughtful supervisory approach.
How much of this is regulation versus supervision, or is it both?
I think it's both. I mean, fundamentally, it's structured at the regulatory rule book, but how we supervise is very, very important, using some judgment. And we're on, most supervisory practices have another important three-letter acronym that's not an intelligence community agency, but CYA instead of CIA. And Silicon Valley is the best example of that. Anyone could take the data of the call report data for 2 years before Silicon Valley's failure and identify immediately, straight up. This great analytical mind here would spot it straight up. But when former Vice Chairman Michael Barr at the Fed published his after-action report, and you see the UBPR financial call report data, and you layer in the supervisory data of when they had a phone call, when they had a board resolution, when they did a bank exam, and you see absolute abdication of responsibility. That's supervisory.
Right.
And that is leadership. It's leadership in these agencies about doing M&A review, doing supervisory guidance. And Treasury Secretary Bissett, who's very active this week and making some fantastic remarks on behalf of the World Bank and the IMF meetings, we've had many conversations about the regulatory guidance, the harmonization approach, to make sure that we get it right at the federal and state level. And I appreciate that leadership commitment. One final point. I mean, I don't believe in regulation by enforcement. I haven't as a practitioner for 4 decades in finance, and I sure don't believe it when I serve in government, either in the Bush administration, up on Capitol Hill in the Senate, or now in the House. It's ridiculous. If you think a practice deserves to be remediated and corrected, let's go through the rulemaking process and have some consensus and do that, and not play gotcha and hijack institutions over some micro complaint that some new staffer at the CFPB has cooked up over the weekend talking to his friend from grad school. Let's go through the process. Let's use the Administrative Procedures Act. Let's have consensus building. That's what made our country the largest, most liquid, most extraordinary capital market in the country.
It's the crown jewel.
It's the crown jewel.
Secretary Bessent a few weeks ago was at ABA, Rob Nichols' wonderful organization, where he talked about deregulation today. He mentioned it. I asked him in the Q&As. Do we need to think about consolidating some of the arguments? You CFPB has essentially been eliminated. Do we need to consolidate some of these agencies? Do we need fewer and a different organizational arrangement, or is the current arrangement fine? We just need smarter, more pragmatic approach, or both?
Well, I mean, even when we worked together, I still have in my collection of campaign buttons one from the Brady Treasury that said one regulator.
Yeah.
And I think every quarter century a new group of thinkers in Washington says, wouldn't it be great if we just had one federal bank supervisor? That's what they do in other countries, blah, blah, blah. And it really doesn't go anywhere, because there's a constituency for our state-federal approach. There's a constituency for a little bit of competition between the agencies among banks of different sizes. You're aware of that. But it creates a little sand in the in the gears of the economy. So this idea of harmonization, strict guidance on that when we do a bank exam, whether it's a in-residence exam at a big bank, where we've got a EIC resident in the bank permanently and you just rotate examiners through the large institutions, or it's an every 18-month state or federal exam in one of our smaller institutions. Everybody's expectations ought to be the same. And I'd say they're not. And when we were at Treasury in the White House, we went through a major recession in 1990, and we had to get the regulators all, quote, on the same page. And Secretary Nick Brady at the time, working with Alan Greenspan, we made those supervisors come to the Treasury. This is how we're going to do a bank exam. We're not going to play gotcha. And so leadership's important. On the subject of too many agencies, I have to tell you, I mean, again, I've been in the industry a long time. When now Senator, then staffer Elizabeth Warren proposed the CFPB back in 2009, I have to tell you, I was very opposed to it. I never once in my banking career had anyone shirk the compliance legal responsibility in a supervisor examiner, period, full stop. The compliance exam in a depository institution or in a broker-dealer or is an excruciating examination. It's without anesthesia as well. And so to say that we need another one, I said, this is just going to lead to confusion and redundancy and added costs. And she said to me in 2009, in May, in Little Rock at the Arkansas Bankers Association, no, we're going to simplify disclosures for consumers, and my goal is that the stack of paper in a mortgage application will be shrunk. Well, has any of that taken place in the last 15 years? No. We've played gotcha. We've added more expense. We've added more intrusion. We've gone beyond the statutory authority. So if one were to eliminate an agency and go back to where that approach was, that would be the one. But I don't think that's even achievable legislatively. And so we've got to focus these institutions and make sure that they're doing a good job in supervision, a tailored job of supervision, a not redundant job in supervision. And Congress has to keep the heat on each administration to achieve that. And I'm pleased that I think Scott Bessent brings that philosophy to the Treasury Secretary, and I think Paul Atkins will bring that kind of leadership at the Commission.
You've been at the leading edge of technological innovation, and you obviously are in the midst of a stablecoin legislative right. You've got the same in the Senate. Where do you want to go with this legislation? Yep. And do you have a timeline? And what do you think the final product looks like?
Yeah. Well, first, I want the United States to lead in this financial technology arena like we've led in other technological innovations and adaptations over many years in the past, whether it's in communications technology or the foundation of the internet or in things as simple as the development of the smartphone. But if we don't get the rules right, we drive that innovation offshore into other jurisdictions, and the venture capital and the venture capitalists follow that innovation out. So if we want to make sure that we do it right, we need the right, I heard the commissioner use the term fit for purpose. I appreciate her copying our bill name last year on that subject. Fit for purpose regulation inside the digital asset space is critical because when you go to a peer-to-peer system, a more decentralized system, you've got to rewrite the rules and supervision covering the plumbing because since 1930, we've done the reverse. We've allowed French to do business with Tim, and we do that through an intermediary. It might be a title company, it might be a broker-dealer, it might be a bank, it might be a custodian, it might be a real estate agent, but we have these intermediaries. And we then set the regulations for them, and they work to police our work between each other. So when you go to a more decentralized finance, that responsibility shifts to the buyer and seller more directly and is a lighter touch on that intermediary. So we are trying to draft those rules. 2 bills, making progress. We did this in the last Congress, but now we're poised to pass these pieces of legislation in this Congress. First is a dollar-backed stablecoin rule under federal law. Bill Hagerty, my classmate at Vandy, has introduced that bill in the Senate. It's gone through a Senate markup. It had excellent bipartisan support. We marked up our version of that bill, the Stable Act, in the House a couple of weeks later. We tried to harmonize those drafts as closely as we could, and the House bill also got bipartisan support. If we think that the future of global payments is going to have a tokenized payment on a blockchain rail, then you need a dollar-backed stablecoin under U.S. law, under U.S. supervision, with high standards of quality and disclosure and auditing to set the global standard that I think will really improve the trust in that product. Secondly, if I have a dollar-backed stablecoin, all I have is an item. I have a tokenized payment concept. But where would you use it? How would you store it? How would Barclays serve as a custodian for it? How could someone use it to buy a digital asset or a regular asset out in the marketplace? And so the second bill that we're working on with the Senate, with Senator Lummis from Wyoming, Senator Gillibrand from New York, Senator Scott, our great chairman in the Senate, and our team in the House, including my good friend Brian Stile from Wisconsin, is a market framework bill. We passed this last summer. It was called Fit for Purpose, the Fit 21 Act. Got 71 Democratic votes across the House floor, very bipartisan. We're going to essentially take on that market regulatory framework bill here in the month of May, and we will work to pass that bill. These two bills are essential to be passed. President Trump has asked us to put both of these bills on his desk before the August recess, and we're working mightily on a bicameral basis, on a bipartisan basis, and working with David Sachs, Donald Trump's artificial intelligence and digital asset advisor, to get this done, and we're going to get it done.
And there's views by many that this could become the de facto global standard, or certainly the standard for many jurisdictions outside the U.S. Do you see that as well? And if that's the case, how does that affect the way you think about it as you write these rules?
Well, I think it'll be a solid standard for the U.S. that will attract capital back into the U.S., attract coders back into the U.S., and let people explore projects for tokenizing both real-world assets as well as digital asset projects that require raising capital. It'll bring clarity to that. I think on the dollar-backed stablecoin definition, I think that'll set the global standard. I think anyone who then wants to compete in that space better have an equally good standard, even if they're not incorporated and not regulated outside the United States.
And you do see us globally, certainly us going to a tokenized central bank rail, and on which private tokenized money will flow.
Well, I think you'll see, and this is a very important point, and it's a real important point for international cooperation, is that just saying it doesn't make it happen.
Right.
I'm saying this is a evolving payment rail that has to prove itself on interoperability, on-ramp, off-ramp, AML/BSA compliance, integration into the traditional finance system so that I can debit cash, credit my stable coin if it's relevant, if I'm going on a trip, or if I'm an international business and I want to have a programmable payment to shrink my accounts receivable days, to speed up my cash flow. These are going to be the products that are going to be developed. But to your point, they are going to be issued by the private sector. And we've seen for 60 years successful integration and interoperability of our payment system, both through central banks, but also through the private sector. If you look at old Bank Americard and what became the MasterCard system to competitors that went from essentially a very over-the-counter ACH credit processing system to now they can participate in a real-time payment.
This morning when Secretary Bassett was here, I asked about financial stability, and he said he'd be getting a lot of questions about private credit in the NBFI space, and I know Governor Bailey will mention this in his upcoming remarks. How do you think about NBFI generally, and is there anything about private equity or private credit that makes you nervous?
Well, they don't make me nervous, but I think, private credit traditionally is a longer-term, fixed-funded source of supply that makes, what we would think of as a intermediate-term credit. There's nothing that mismatches asset and liability risk there. You've got pricing risk. You've got credit quality risk. You have the GSIBs now providing warehouse lines to the private credit industry, which is where I think it principally touches the depository institutions, and that's a credit decision that needs to be looked at closely. In the hedge fund space, I think I formed a special task force this year for the first time in the House to look at monetary policy. I've asked Frank Lucas to chair it from Oklahoma. This mission of this is to focus on evaluating the Fed's role since Dodd-Frank, and particularly since the pandemic, on how they're doing on their goal of price stability, how they've changed the operation of monetary policy since the financial crisis, and evaluating that. But this is where it touches Treasury market structure, which is always not been fulfilled in Congress's oversight there. It's not in the Charlie Munger too complicated pile, but the course of business just seems to make it a secondary issue. I think they're linked, and in a world of enormous federal budget deficits, they're even more linked. And so we're looking at Treasury market structure in that same task force. We're talking to the primary dealers, we're talking to market participants, and that's where your question about the hedge fund space touches the committee's jurisdiction, because family offices, hedge funds have made enormous buyers in the Treasury market, the Treasury futures market. Right. That's changed the nature a bit, but that's also because of the mistakes in Dodd-Frank to take our money center, our GSIB banks out of the intraday Treasury market. And so we're going to look at the regulatory impact and the market impact of how monetary policy and Treasury market structure work together. And I think it's a very important task. I'm so glad Frank was willing to take it on.
In our closing 2 minutes, let's just talk about the economy and market confidence. Obviously, a lot of volatility in the markets. The last couple of days have been much better, but since January, we've seen sell-off in all the major indices. A lot of concern about slowing growth, forecasts for potential recession. What are you hearing when you go back to Little Rock? What are the people on the street of Little Rock telling you about their view about the markets, the economy, and are they concerned?
Well, for the decade that I've been in Congress, before I was in Congress, I was a banker in Little Rock, my hometown. I was the chairman of the Chamber of Commerce, very involved in economic affairs in my home state. And for the decade, the number one complaint's always been finding the right talent from a human resources point of view to carry out whatever the mission of the business is. And that continues to be the top concern. There is workforce, whether it's white collar, cyber, engineering, healthcare, or logistics. But uncertainty is, risen to the top in the last few weeks over the tariff strategy of the administration. Because 30% of our output in Arkansas goes to Canada and Mexico, I have enormous international companies in my district, many from France, but from around the world. We're a capital city. We're a logistics hub in the Mid-South, and so it's a busy place. And people want certainty, and I think that has risen to one of the top concerns. I met with a lot of my major industries last week when I was in Little Rock. I had both steel fabrication and production, as well as retailing and everything in between, and we talked specifically about what their outlook is for 2025, how they're anticipating their business strategies to cope with this very back and forth, on again, off again tariff point of view. So this is something that I would urge the president to resolve quickly, because on regulation, we're moving in the right direction. Rebalancing, tailoring. On taxes, Congress will meet next week and start budget reconciliation, where we're going to work hard to commit that small businesses, entrepreneurs, families are not going to have a tax increase at the end of the year. We want to give predictability to that, and that we are going to drop the slope of the rapid growth of spending coming out of the Biden administration, the pandemic, where we just went out of control in federal spending. So regulation going in the right direction, spending and taxes, in my judgment, could be going in the right direction. Those are good things. So we want to get the trade issue in the right direction, in the right groove, and make sure it's producing results for the economy and for all of our citizens, so that good news is not stepped on by less successful.
Chairman, I wish we had more like you. You're a national treasure, and I
Appreciate
sleep
it.
better at night knowing
Thank you
you're in
very
your
much.
job. Ladies and gentlemen.
Great American right here now. Appreciate you.